The output of an economy is typically described in terms of GDP, gross domestic product, or the cash value of all final goods and services rendered in a given amount of time, like a quarter or a year. If we wanted to get this value for the United States, we could literally survey every firm in the economy and ask them how much total inventory they held last year, or the cost of all the services that they provided. We would still need to know who were the recipients of any of this inventory or services. That's the only way to really get at the final output. But another, perhaps more straightforward approach would be to collect information on value added. You see, the final output of an economy should theoretically be the same as the value added in every part of the supply chain behind the final goods and services produced. In other words, or perhaps accounting words, the difference between the cost of goods sold by every firm in the economy and the value of associated revenue and leftover inventory held by them is the same as the total output for the economy. Any firm-on-firm transactions would be netted out, such that the only transactions with households and government would be counted, which is the personal consumption and government purchases portions of GDP, respectively. And inventory or new capital purchased, which is effectively the gross private investments component. An open economy complicates this example, but most governments can probably account for their net exports in a separate and hopefully more direct measurement of cross-border flows anyway. Getting back to the value-added approach, your textbook gives an example of this with the final output being a house, following how the sum of the value added at each point of the development chain is equivalent to the value of the final output, the house. Value-added accounting is also relevant to tax policy, with implications for reducing tax evasion. The circular flow models offers us yet another way to measure the size of the economy. Remember that the larger point of the model is that cash flows circularly around the economy, such that everyone's income is someone else's paycheck. If that's true, the output of the economy can be measured through either GDP or GDI, gross domestic income. By the logic of the circular flow model, GDP equals GDI. So if we know everyone's income in the economy over a certain period of time, then theoretically we know what the size of the economy was over that same time period. For some economies, this may be the easiest way to measure output because the components of GDI are easily measured through existing processes, like assessing direct tax liability. Direct taxes usually require knowing information specific to the filer, such as family makeup and military status, but also how much income they earn. Actually, you can basically line up most of the components of GDI, compensation, profits, rental income, net interest, and depreciation, with entries on the US IRS 1040 and its supporting schedules. The last component, indirect taxes, are collected by the government, usually through sales and sometimes property taxation, and therefore are already measured. You can probably see, too, how the components of GDI overlap with GDP, with the government collecting its revenue from indirect taxes and direct taxes accounted for in the other components of GDI. GDP may not be an appropriate measure for your economy's output. If significant income is generated for residents of an economy by factors of production outside that economy, like oligarchs in developing nations generating earnings from factories and other capital assets they own in the Western world, then it may be more appropriate to use GNP or gross national product. The national part of that means it accounts for any income generated by residents of a nation, even if the factor generating that income is in another country. It also subtracts any income generated within your country by assets owned by residents from other countries. To arrive at GNP, though, you're still effectively going to need to figure out GDP to understand what part of your domestic output is coming from residents versus non-residents. Actually, we can even trace income from the macroeconomy to households by knowing GDP, GNP, and GDI. Add in income from overseas. Subtract out consumption of fixed capital, take out taxes, add back transfer payments, and you basically have disposable personal income, or the money on net that households get to spend or save.